Hi everyone, we've moved into chapter 4 now, which covers corporate non-liquidating distributions, and I thought it would be helpful to walk you through a few of these PowerPoint slides on the chapter, which as a reminder are available to you guys as well. If you go into tools and then the multimedia library in My Accounting Lab, you'll find for each chapter actually there's a PowerPoint presentation of slides. And sometimes other items in the library for each chapter. So just remember that those are available to you as well. So first of all, when we're making a distribution, a non-liquidating distribution, we need to understand what the earnings and profits of the corporation is. And the reason we need to know that is because under Section 316 in the code, any distributions coming out of, to the extent of current E&P or accumulated E&P, are deemed to be considered dividends. And Section 301 of the code tells us that dividends are taxable to shareholders. So let's say that the corporation has accumulated E&P of negative $50, so it's actually got an accumulated E&P deficit as of the beginning of the year of $50, but it has current E&P earned during the year of $10. If it makes a distribution of cash to its sole shareholder of $5, and you first deem the distribution to come out of current E&P and then out of any accumulated E&P. So in this case, because there's current E&P of $10 and the distribution is only $5, the entire distribution of $5 of cash would be deemed a dividend to the shareholder. However, if the distribution was $15 and we only have $10 in current E&P and we don't have any accumulated E&P, because remember we had a deficit of $50 at the beginning of the year, then only $10 of that $15 distribution would be considered to be a dividend, because that's our current E&P balance as of the end of the year. And you always look at current E&P as of the end of the year without regard to any distributions. So you don't reduce it yet by any distributions, and then you apply your distributions in pro rata order. And so then the excess distribution of $5 would come out of the basis in the shareholder's stock. So to the extent that his basis in his stock is $3, then $3 would be considered, of that $5 excess, would be considered a return of capital and would reduce his basis in his stock down to $0. And then the excess $2 of distribution would be treated as a capital gain to the distributee shareholder. So it's important, therefore, for us to understand what E&P is and how we calculate E&P. We have issues that we need to resolve for the shareholder upon distribution. We need to know the amount of the distribution and why, because we just discussed how you're going to treat a distribution. We need to know whether the distribution's a dividend, because if it's a dividend, then it's taxable to the shareholder. We need to know what the shareholder's basis is in the property that he receives from the corporation, and we need to know what his holding period is going to be. Does he start fresh with the property, or does he take a carryover in the holding period? As we learned in some prior chapters, sometimes you take on a fresh holding period, so you start at day 0, and sometimes you take on the holding period of the distributing corporation giving you the property. And then we also have issues for the distributing corporation. What's the gain or loss realized upon distribution? What portion of that realized gain or loss is recognized? If the corporation is just distributing cash, then we know that there's no realized or recognized gain or loss, because fair market value of the cash equals the basis of the cash. But if we have either appreciated or depreciated property being distributed, what appreciated property means that the fair market value is actually higher than the basis in the property being distributed, and depreciated property means that it actually is a loss. It's a loss property being distributed, so the fair market value is actually less than the basis. In that case, we have a realized loss if it's depreciated property, or a realized gain if it's appreciated property, but we may or may not recognize all of that gain or loss. We also need to know what the character of the gain or loss is, and we need to know what impact the distribution has on the corporation's earnings and profits. Why? Because as you realized from this slide, you want to be tracking the corporation's E&P on a regular basis if it's the type of corporation that regularly distributes property. And even if it doesn't, as a practitioner, it's a good idea to talk to your client, your corporate client, about tracking its E&P. And if it hasn't ever tracked its E&P, offer to do what's called an E&P study, where you actually go through and you calculate from day one of the corporation's existence its E&P. And you would calculate it on a yearly basis and track it in, like in an Excel schedule, so that if and when the corporation does make a distribution, you're not running around like crazy trying to figure out, did it make a distribution in excess of E&P? And a lot of corporations will fail to track their E&P, and then all of a sudden they're making a distribution for the first time in 10 years. And we as tax practitioners have to say, oh, how's that distribution going to be treated to the corporate shareholders? Is it going to be treated as a dividend coming out of E&P, or is there no E&P and therefore it's going to be treated as a return of capital, and maybe even a portion of it treated as capital gain? Here's an example here, which I'm not going to go through right now. So we talked about this. You do calculate current E&P annually, and E&P is calculated as of and looked at as of the end of the year, as I said, without regard to any distributions made, when you're trying to then determine what portion of those distributions are going to be considered to be a dividend. Accumulated E&P is defined as your previous year's undistributed current E&P minus previous year's current E&P deficits minus all distributions made out of accumulated E&P. That's your accumulated E&P as of the beginning of the year. To calculate current E&P, we start with taxable income or tax loss. If there's a current net operating loss, then it would be a tax loss. And then we add and subtract certain things that are either non-deductible for E&P purposes or taxable or non-taxable for E&P purposes. So here's our summarized formula for calculating current E&P. But we need to know what all these pluses are and what all these minuses are. Here's some examples of income excluded from taxable income but included in E&P. So in other words, even though you're not including these items in the taxable income, you would add them into E&P, which means that when you start with taxable income, you would then add to taxable income each of these items if you have them. Tax-exempt interest, life insurance proceeds, where the company is beneficiary. We knew from a previous chapter that both of those are permanent, non-taxable amounts, right? They're permanently non-taxable. Recoveries of bad debt, where there was no tax benefit, and federal income tax refunds. You will start to see a theme here. Most of the items that are that either reduce or increase E&P are going to be perm differences. So that you accounted for, book tax differences that you accounted for when you are calculating taxable income, like these first items here, and actually this last item. The recovery of bad debt is actually a temp difference. And then here's some things that you would include in E&P. You would include in E&P that you didn't necessarily include in the current year for tax return purposes, for taxable income purposes. Deferred gain on installment sales. For E&P purposes, you include everything all at once. And then here's some income/deduction items that have to be recomputed for E&P. So in other words, they have there are different ways that we calculate these items for E&P purposes than we do for tax return purposes. And the main one that you're going to see a lot of is the difference between tax depreciation for tax return purposes and tax depreciation for E&P purposes. For E&P purposes, we actually use straight line for non-makers property, and then for makers property, which is any property put into service after 1986, we use the ADS, or the alternative depreciation system, for depreciating that property. And the list goes on. You can find this list in a really nice table on page 4 of your text, and you're going to want to use that in order to calculate E&P and a couple of the problems that we've been given. And I really do like these slides, though, because they're just a little bit more detailed, and yet it's a nice summarized version of what you read in the text. You can see I've gone through most of this. Current versus accumulated E&P. If a distribution exceeds your current E&P, then you allocate your, and this is when you have more than one distribution, then what you do is you current E&P is allocated on a pro rata basis, and then any excess distributions over current E&P are taken out of accumulated E&P in a chronological order. So if you had distributions first quarter, second quarter, third quarter, and fourth quarter, you would chronologically take those distributions out of your accumulated E&P once you've wiped out your current E&P. And then any distributions over accumulated E&P are then either a return of capital, and to the extent that all of your capital is deemed returned, then they would actually create a capital gain for you. So now we talk about one of our questions that we had to answer, and that's the impact to the shareholder on property distributions. When the corporation distributes property, the amount that's deemed distributed is the fair market value of the property received less any liabilities assumed by the shareholder, but not reduced below zero. And then to determine if it's a dividend, we do our E&P, we look at our E&P. The basis in the property received is generally going to be the fair market value, and it is not reduced by any liabilities assumed by the shareholder. The holding period is going to begin on the day after receipt. So we now know we do not take a carryover in the holding period. We actually start fresh. And that's my dog whining in the background. The impact to the distributing corporation is that the gain or loss realized is deemed to be equal to the greater of the fair market value of the property distributed or the liability assumed minus the tax adjusted basis. and then the gain or loss recognized, you would recognize any realized gain, but you do not recognize any realized loss. So they've got a note here that says that it would be actually good to sell lost property instead of distributing it. That's just a tax tip, right? That would be a tax planning tip. The character of the gain depends upon the nature of the underlying asset. Does that make sense? So if you're distributing securities like stock in another corporation that the distributing corporation owns, that's a capital asset to the corporation. So therefore, if there's capital gain realized upon distribution, if there's gain realized upon distribution of that stock, then it's going to be capital gain to the corporation. And then the impact of the distribution on the corporation's E&P is this. The E&P has to be increased by the E&P gain. So the fair market value minus the E&P basis of the distributed property must be increased. And then if the E&P basis is equal to or exceeds the fair market value of the distributed property, then E&P is reduced by the E&P basis, net of any liability and tax on the gain. And then if the fair market value is greater than the E&P basis, then E&P is reduced by the fair market value, net of liability and tax on the gain. Okay, so we're going to stop here, class, and then I'm going to walk you through very quickly the problem 4-28, which you guys also are going to be asked to do. It's going to be a similar problem to this one. And I've already solved the problem for you so that we can just walk through it very quickly. As we discussed in the slides, you always start with taxable income when you're trying to calculate E&P, and that's the goal of this problem, is to calculate E&P. And they gave you in the information taxable income of $500,000. Then they give you all this other information. One piece of information they give you is that there were dividends received of $80,000 from a 10% owned corporation. And we know that when a corporation receives dividends, it is allowed a dividend received deduction equal to, in the case of 20% or less of an owned corporation for which it's receiving dividends, 70% dividend received deduction. So if you multiply 70% times 80,000, you get 56,000. So that would have been the DRD, the dividend received deduction, that the corporation would have taken and that would have been included, we're supposed to assume, in the 500,000. For E&P purposes, we need to add that back. That's non-deductible, as we saw in the slides, and as you can see in the table on page 4 for E&P purposes. Same with the NOL deduction that we took that's given in our information that's already included in the 500,000 taxable income. That $20,000 NOL carryover that we deducted from current year income is non-deductible for E&P, so we have to add it back. Same with regard to the DMD, the Section 199 deduction, the production activities deduction of $10,000. That's non-deductible for E&P. And lastly, they tell us in the facts that there's $40,000 of depreciation that exceeds the depreciation allowed for E&P purposes. So of the total tax depreciation taken that's part of the $500,000 of taxable income, 40,000 would not be allowed for E&P purposes. In other words, if they took $300,000 worth of tax depreciation, only $260,000 of depreciation would be allowed for E&P purposes, because you'd be calculating it under the ADS system, the alternative depreciation system. So we have to add back that 40K also. So we get a subtotal of add backs of 126. Then we have some things that we get to subtract or that we have to subtract. We like pluses to E&P, right? Because the more E&P we have, well, we like it in some cases. Sometimes a corporate share or a shareholder, either a corporate or a non-corporate shareholder, wants their distribution treated as a dividend. Maybe because they want to be able to use NOL carryovers that they haven't been able to use. But in other cases, they don't want that distribution treated as a dividend. So these pluses and minuses could be good things or bad things, depending upon the distributee shareholder's situation. So some things that are not allowable for E&P purposes or that are allowable for E&P purposes, sorry about that, are long-term capital losses. We know that net capital losses for corporate purposes are disallowed and need to be carried over, but for E&P purposes, they're deductible in the current year. So in the facts, we learned that we had 80,000 of excess capital losses. So we deduct those. We also get to deduct the $6,000 in penalties that are a perm difference for tax purposes. They're permanently non-deductible, but for E&P purposes, they are deductible. And lastly, we actually have to know what our federal income tax liability was, because the federal income taxes are actually deductible for E&P, even though for tax purposes we know that they're never deductible. That's another perm difference. So I actually multiplied 500,000 times 34%, which is the tax rate given up here. Assume a 34% corporate tax rate, and I come up with 170,000. So now my total reductions to E&P are 256, and I basically just add down 500 plus 126 minus 256 is 370,000, and that's what my E&P is. E&P is not that difficult to calculate if you know what the parts and pieces are. So it's nice to be able to know where in the code you can learn about the differences in E&P, and that's in the 300s, in 316 and 312, and you also can use your table in the text. I hope this has been helpful, and I'll talk to you soon.